Hey everyone, my name is Sherman, a CPA here at LYFE Accounting, where we help you save on taxes and increase your wealth. Today, I'm going to help you do this by giving you the top tax avoidance strategies for business owners. Now, in a prior episode, I went over the top tax avoidance strategies for individuals. We talked about things like itemized deductions, long-term capital gains, and various types of investment accounts you can set up to avoid taxes. So if you haven't seen that, make sure that you are subscribed to our channel and check that out after watching this. But today's episode is all about tax avoidance strategies for business owners. By simply owning a business, you will have access to many more ways to avoid taxes that are written inside of the tax code. If you own a business or you are thinking about starting a business, then go ahead and help me get started here by clicking the like button below. And stick around until the end of this episode so you can find out on how to save more money on your taxes. All right, so the first thing you need to understand is that entrepreneurs receive special tax breaks to encourage job creation. Nothing that I'm about to tell you is illegal. Lawmakers purposely added tax benefits for business owners to grow the economy, create jobs, and drive innovation. And these special tax breaks mainly come in the form of tax deductions, tax credits, various entity tax strategies, and more advantageous tax-deferred accounts. So let's go ahead and look at these tax breaks that can help you avoid paying taxes. Tax avoidance strategy number 1. Turn personal expenses into business expenses. Here's the question that you need to ask yourself right now. What if you could get an additional 20 to 30% discount on purchases that you are already making? Well, you can do this by turning your personal expenses into business expenses. Because when you have business expenses, they can qualify as tax deductions that lower your income and result in lower taxes. Section 162 of the Internal Revenue Code says that all ordinary and necessary expenses incurred to carry on any trade or business shall be allowed as a tax deduction. So as long as the expense is ordinary, meaning it is common and accepted in your industry, and necessary, meaning it is helpful to conduct or grow your business, then it is allowed as a tax deduction. Do you want to buy the new iPhone Pro Max? Well, buy it, use it in your business, and write off the entire expense when you file your tax return. Do you operate your business from home? Well, calculate the square footage of your home devoted to your business, take all of your home expenses, and multiply it by the percentage of your home that is used for business, and use that amount as a tax deduction. Do you eat out with your business partners, team members, or clients? Well, in 2021 and 2022, you can write off 100% of your business meals. You get to enjoy your food and the tax benefits associated with it. I could go on and on about how business owners write off almost anything, from their business vehicles to vacations. But the idea is that as a business owner, you can write off almost anything. And we already have episodes on our channel that explain these topics even further. So just make sure that you're subscribed and check them out. All right, tax avoidance strategy number 2. Take the 20% QBI deduction. The QBI tax deduction is another tax deduction that is not directly tied to a business expense that you actually incurred. The QBI tax deduction, which stands for qualified business income, allows you to deduct up to 20% of your qualified business income. So let's say your business made $500,000 in revenue with $200,000 in expenses. Well, in that case, how much would it save you in taxes? Well, the first thing we're going to do here is use the first tax strategy, which is taking $200,000 in tax deductions for those expenses to lower our business taxable income to $300,000. Then with the 20% QBI deduction, you will be able to deduct another $60,000 from your taxable income, lowering it to $240,000. So literally, by taking all of these tax deductions, we just cut our taxable income and the taxes we would owe in half. Now, to use the QBI tax deduction, there are some rules around who it applies to and what qualified business income really means. So if you want to learn more about that, check out my video that goes in much greater detail on this tax deduction. Tax avoidance strategy number 3, deduct depreciation expenses. This is yet another tax deduction you can take that does not directly cost you any money. If your business owns any property at all, like an office building, machinery, vehicles, or other types of equipment or capital assets, then you can deduct your depreciation expenses from your business income. Technically, when you buy property like this, you are buying an asset. And an asset purchase is not a tax write-off. It's not an expense. However, assets do depreciate over time, and you can deduct the depreciation expense over its useful life as a tax deduction. And the cool thing about depreciation is that it has nothing to do with what you actually paid. For example, let's say you bought some equipment for $10,000, but you decided to finance the entire purchase. So no money actually came out of your pocket to purchase this equipment. Well, even though you put no money down towards the asset, you can still take depreciation expense on that purchase each year because you own it. So if it has a 5-year useful life, you could take a tax deduction of $2,000 in depreciation each year, even though you may not have actually incurred $2,000 in expenses. That's literally how powerful depreciation is. It works like magic, especially in real estate. And in some cases, you can even accelerate the rate of depreciation that you take that result in even higher tax deductions, which means more taxes you can avoid at tax time. Tax avoidance strategy number 4, claiming business tax credits. This tax avoidance strategy involves using business tax credits to avoid paying taxes. Now, tax credits work a little bit differently from the tax deductions we've discussed so far. Tax deductions lower your taxable income, which in turn lowers the amount of income that is subject to taxation. Therefore, the true tax savings of these tax deductions will be configured by taking the total amount of these tax deductions and multiplying it by your effective tax rate. For example, $100,000 in tax deductions multiplied by a 25% effective tax rate would mean you would save $25,000 in taxes. However, tax credits, on the other hand, directly reduce the amount of taxes you owe. So $100,000 in tax credits equates to $100,000 in taxes saved, which is 4 times more valuable than the tax deductions that we just described in this scenario. Now, there are many different tax credits out there to encourage job creation and innovation, such as the Opportunity Zone tax credit to incentivize businesses to locate in developing areas. And a lot of these places are not terrible places to do business from. I claimed this credit while working in the heart of downtown Atlanta. And then there's the Research and Development tax credit to help businesses increase innovation and efficiency. So if you are developing or improving any business process, techniques, formulas, or inventions, then definitely check out this credit. And then there's also the Work Opportunity tax credit to incentivize business owners to hire groups of people who have faced barriers to employment, like veterans, people with disabilities, ex-felons, and so on. If you hire anyone in these groups, then this tax credit can help you avoid taxes. And those are just some of the tax credits that are available. There are many more credits out there, like credits for offering health insurance to your employees, or using electric vehicles, and so on. So if you are interested in learning more about tax credits, let me know in the comments below, and make sure that you check out the current tax credit video on our channel. Tax avoidance strategy number 5, converting from an LLC to an S corporation. This is a popular tax strategy that many business owners use when their business income exceeds $50,000. Now, the sole purpose of electing to be taxed as an S corporation is to avoid paying self-employment taxes, which is about 15.3% of your total income up to a certain amount. Now, owners of an S corporation do not have to pay any self-employment taxes at all, but they do have to pay themselves a reasonable salary, which is subject to payroll taxes. However, when done correctly, Electing S Corp status can save you thousands of dollars in self-employment taxes, which is just more money that you can reinvest into your business. I always tell people that if you want to change your tax, change your facts. And a simple fact change is electing the best entity to save you the most money in your taxes. To learn more about this, watch our video on LLC versus S Corp. Tax avoidance strategy number 6, investing into solo 401ks or SEP IRAs. In my last episode on tax avoidance strategies for individuals, I talked a lot about using IRAs, HSAs, and 529 accounts to save on taxes. A lot of these plans provided a few $1,000s in tax savings each. Well, solo 401ks and SEP IRAs provide almost 10 times the amount of tax savings you can earn from these type of accounts. These are retirement savings accounts that allow you to deduct up to $58,000 in income from your taxes by simply making contributions to them. For some context here, a traditional IRA only allows you to deduct about $6,000 to $7,000 per year in total contributions. Now, both of these plans work in very similar ways, but they do have some different rules and complexities on how to go about setting them up. I've already created episodes that go into these types of accounts in greater detail on our channel, so be sure to check them out if you are interested in learning more. But the bottom line is, if you own a business, you can vastly decrease your tax liability by setting up these types of accounts.